makers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London with the conversations that matter. And here's what's coming up on today's program. U.S. auto workers strike at the big three car makers for the first time in history, setting up a showdown over wages and job security. China's economy picks up steam in August after a summer travel boom and more support measures from the central bank. Plus, a shot in the arm for markets as ARM soars 25% in its trading debut after raising $4.9 billion in the year's biggest IPO, delivering a boost for SoftBank and its founder Masayoshi Son. Now, first thing is first, so let's take a look at the European markets map. We're also hoping to get some of the pre-market moves from some of those U.S. automakers for you. Now, so far, stocks in Europe are up, commodities really pushing the decline or pushing the rally after better than expected economic data in China. And that's, of course, fueling hopes that the nation's stimulus measures are starting to pay off. The one currency you need to watch out for is euro-dollar. We'll put it on the screen in just a second, but the euro headed for a record run of weekly declines. You can see the DAX gaining 1%, CAC 40 actually gaining 1.4%. We'll have a full rundown, of course, of also what's going on with the ECB after we heard from Christine Lagarde yesterday. Now, the other news story we're watching out for is TSMC asking suppliers to delay some of the chip equipment deliveries. Now, that's according to Reuters. Unclear whether that's because they need a little bit more time for the supply chain to normalize or whether this is on political pressure. Certainly ASML in the market today down 2.9%. So three big stories we're watching this morning. Oliver Crook is keeping an eye on the automaker strike. Alan Wan has the latest on the Chinese economy. Plus, Jake Rudnitsky will tell us about the biggest IPO of the year. So first, let's go to Ollie Crook on the strike by U.S. automakers or auto workers as a contract negotiation deadline expired at midnight New York time. The walkout, Ollie, will hit General Motors, Ford, Stellantis at really strategic locations in several states. So what does this mean for the near future?
That's right, Francine, and this is sort of a historic moment where it's hitting all three at the same time, and it's three companies, three different states, 13,000 workers. What are they asking for? 36% increase in wages. They're talking about a 4-day work week and also talking about a COLA, a cost of living allowance, to basically insulate their paychecks from all of this inflation that we've had in the recent years. And the automakers, they've offered GM and Ford 20%, Stellantis, they've offered 17.5%, but that has not been enough. We are on strike today, so the rest of the workers will continue to work on an expired contract, but it could escalate very soon.
So, Ollie, what's the strategy here for the union?
So what's really interesting is that they've gone progressively. Yes, three companies, yes, three states to show the reach that they have, but only 13,000 workers. Remember, they have 150,000 workers. So they're keeping dry powder, which the president of the union said he's willing to use.
This strategy will keep the companies guessing. It will give our national negotiators maximum leverage and flexibility in bargaining. And if we need to go all out, we will. Everything is on the table.
So everything is on the table. They could expand this strike at any moment, really keeping them guessing. But the problem that the union has is they have a strike fund, which is limited. That continues to compensate workers that are not working. If all 150,000 workers went on strike, that could last only 11 days. So what they're doing is strategically targeting the factories and assembly plants that create the highest margin cars in order to put maximum pressure on the automakers.
Ollie, thanks so much. Oliver Crook there in Frankfurt now, or actually Berlin. Economic activity in China gathered pace last month with industrial production and retail sales coming in better than expected. Well, joining us now is Bloomberg's Shenzhen Bureau Chief Alan Wan. So, Alan, good morning. What were some of the highlights, lowlights of today's data?
Well, the highlights you just mentioned, industrial output and retail sales grew more than 4% last month, much faster than expected. And this just follows in a recent, it shows that the growth is stabilizing in China. The economy is starting to stabilize. We've had recent data showing exports and manufacturing, the pace of decline is moderating, credit recovering, and even deflation starting to ease. So this sort of reinforces the belief that that part of the economy is starting to stabilize. And even on youth unemployment, the government said that the youth unemployment had improved, although we don't have any data to support that. We're just going to take their word for it. In terms of lowlights, it's still the property market. Yep. Home prices fell more than expected. And fixed asset investment grew slower than expected due to declining property investment.
Alan, thanks so much. Alan Wong there with the very latest on the Chinese economy. Now, shares of chip designer ARM also climbing 25% in their trading debut in New York. That's after they delivered a boost for both equity markets and SoftBank. So let's get more with Bloomberg's Jake Rudnitsky. Jake, what did we actually learn from ARM's first day of trading? They flew off the shelf for now. Can they keep it up?
Well, it looks like the IPO market is back. I mean, up until ARM's debut, the IPOs, it has been the worst year since 2009, so basically the financial crisis. And with ARM coming out roaring, it looks like there's going to be a lot more interest in companies going public. The pipeline is looking pretty positive.
So does this actually mark the start of an IPO revival?
Well, it certainly does look like it, and it's not just tech companies. I mean, we do have companies like Instacart that are planning to list, but also Birkenstock, the German footwear maker, is looking at it, and it sounds like there are dozens of companies that are exploring IPOs right now, and so it looks like there's a lot of pent-up demand.
All right, Jake, thanks so much. Jake Rudnitsky there with the very latest on ARM, one of the biggest so far IPO this year. Now, coming up, we dive into the markets with Daniel Pinto. He's founder and chief executive of Stanhope Capital. Now we get his thoughts, of course, on the much talked about chances of a soft landing for the U.S. economy. That's next, and this is Bloomberg. The conversations that matter, the insights you need. This is a Pulse. I'm Francine Lacqua here in London. Also, happy Friday, everyone. It has been a long week for most market participants. Now, some pretty strong data from the U.S. economy has revived speculation that the Fed will be able to engineer a soft landing, even if it keeps interest rates higher for longer. Well, joining us now is Daniel Pinto. He's the founder, chief executive, and chairman of Stanhope Capital, an asset management firm he started back in 2004 with $27 billion of assets under management. So Daniel, thank you so much for coming on to give us a little bit of a glimpse of what you're looking at. Now, I guess the premise of how you do your investment strategy is the US is growing more than Europe. So we have charts which we'll show in just a second, but what do you worry about for Europe?
Well, the first thing to say is that so far so good for the Federal Reserve. They have been able to manage this fight against inflation pretty well. But they are at a tipping point, which is that they will have to announce a decision next week. My view is that they should stop raising interest rates, and they can absolutely organize a soft landing. I am much more concerned about Europe. We are in a position today where inflation in Europe runs at about 5.5%, where GDP growth is nil, where Germany is probably in a recession, and where pretty much the ECB is stuck between a rock and a hard place, which is, on the one hand, they say we might be done with raising interest rates, happened yesterday, but at the same time, inflation is still at 5.5. And there is the danger zone, if you will, because if they make the wrong move next time, they can actually tip the European economy in a deep recession as opposed to a mild recession.
Daniel, what is a wrong move at this point? So what they're thinking is they pause, although she didn't 100% commit to it, President Lagarde, and then you see what happens to this extremely fast tightening of interest rates.
Yeah, I think they should take the risk. I would agree with the position that they seem to be taking, which is not to raise interest rates. I mean, to do it for one last time, but then pause. Because again, if the trade-off is let's run with higher inflation or let's tip the European economy into a deep recession, obviously they have to accept a bit higher inflation. That is the best trade-off. And I really hope they do that. They seem to be heading in that direction.
Daniel, this is probably the chart of the week, if not the quarter, and it's looking at consumption, and this is something that you highlighted to us It's basically the difference between U.S. and EU consumption chart. And you can see how these two economies are bifurcating, or certainly are behaving very differently. Again, are these structural concerns that Europe can fix, or is it just because of the proximity to Ukraine and the energy complex?
No, I think that there are structural concerns. Just to give you a couple of figures, in 2008, the US economy and the European economy were roughly of the same size, about $14–15 trillion. Today, the US economy is worth about 28 trillion, and the European economy is still at 14–15 trillion. No growth. Point number one. Point number two, you look at consumption expenditure. It was about 12.5 trillion in 2008, both for the US economy and for the European economy. The European economy has stayed flat, no additional consumption. The US is at 17–18 billion. So this is absolutely structural. We have lost the key, we have lost the formula for growth in Europe. The US, in spite of everything people say, has maintained a degree of growth, largely fueled by technology. And one of the concerns is that we are laggards in terms of technology in Europe, UK and Europe. Just to give you a sense, today technology stocks represent about 30% of the S&P. They represent only 7% of the European economy, of the European market. And because these stocks have been the biggest producers of earnings, then you wonder, why has the US market outperformed Europe? Well, that is the reason. We have missed on the biggest source of earnings growth for the last 15 years.
But this is not a lack of innovation. You have companies like ARM, British-born, and then listing elsewhere. So is it a lack of capital to grow, or is it really, again, a structural problem that maybe policymakers need to fix?
This is, first of all, an ecosystem in Europe which is bad at investing in growth companies and technology companies. And that's true in the public markets, and that's true in the private markets. If you look at the public markets and take the case of the UK, pension funds used to be very active participants in IPOs, in equity markets in general. They used to own about 50%. I mean, 50% of their portfolios used to be comprised of UK stocks 20 years ago. Now it's 5 or 6%. So if you do not have the engine of capital to support growth, guess what? Companies that are the fastest growing companies prefer to go to the US as ARM did. And that's a major problem for us. So it's not a lack of innovation. It is partially a lack of innovation in areas related to digital. I think we have our champions in Europe, if you will, tend to be in hard tech, not in soft tech. Yeah. But it's also a fundamental problem in terms of capital available, both in public and private markets, for innovation. But
is there also worry that some of the capital is being sucked into private assets? So this could be private credit and private equity.
In part, I think that it is a fact, a growing appetite for private debt in Europe, etc. And I think you see a lot of these big institutions, instead of funding innovation and growth, they go for lower returns in private debt because they feel it is safer. And it is a problem. You cannot dictate to them to do what they do with their funds. But you're absolutely right to point out that the money is heading in the wrong direction.
What do you worry about the most for Europe? I know we talk about the fact that nothing's broken, despite interest rates, having risen by so much in so little time. Are you expecting defaults in this kind of situation where growth is not as strong in the U.S.?
I worry about stagflation in Europe. I worry about a position where inflation comes down, because it will come down, but where growth is anemic, and where you have a period of a year or two of stagflation. And the problem with stagflation is that it kills corporate margins. No. In other words, you see companies making less and less money and sometimes losing money. I worry about that, and that's why we have said to our clients, not just recently, but for the last few years, that they should have the majority of their equity exposure into the US.
Okay, Daniel, thank you so much. Daniel Pinto, their founder and chief executive officer of Stanhope Capital, stays with us. In the meantime, I need to bring you a couple of stocks pre-market. So they'll be, of course, they're listing in the U.S., so we'll see how they open in a couple of hours from now. But for the moment, ARM. So let's see whether we have that stock. ARM, of course, this was the big story yesterday. And you can see yet again another rise after it's risen quite significantly on its debut yesterday. Pre-market today, ARM Holdings gaining 9%. And then the other story, of course, that we've been following very closely are some of these strikes by Detroit car makers after deadlines for new contracts actually lapsed. I think we also have that pre-market. You can see Ford and General Motors down 1.9 and 1.6% respectively. Now, coming up, we get the latest on the world's second largest economy as China reports better than expected industrial production and retail sales. We're back with Daniel Pinto. This is Bloomberg. Welcome back, everyone. Now, still with us, Daniel Pinto, Stanhope Capital founder and chief executive. Daniel, thank you, first of all, for sticking around. We were talking a little bit about, I guess, the dynamics between the U.S. and Europe. When you look at ARM and the fact that they listed elsewhere, is this really symptomatic of how the UK is hurting?
Absolutely. Sadly, all these companies that have the prospect of valuing themselves at very high multiples across the Atlantic don't even hesitate. They just go for a listing in the US. And the reasons are clear. There is a much deeper pool of investors in the US. Number two, the UK sadly has lost its desire to invest in growth companies. As you know, most investors in the UK are value investors. They love high dividends. And guess what? If you are a value investor enamored of high dividends, you just invest in traditional companies, not in companies like ARM that are going to trade at 100 times earnings or more. And so that is a malaise, if you will, that is affecting London. And unless it is fixed by changing pension rules, by changing rules affecting insurance companies, it will carry on, sadly.
Who will change that? Is it this government or is it the next government?
Well, this government is saying the right things, but is very, very slow for some reason. You know, they've been talking about changing listing rules for months, maybe a year, and it hasn't happened yet. They've been talking about doing something about pension funds and promoting mergers between pension funds to create, giants. Hasn't happened yet. So, unfortunately, time is running out because we are losing traction. Just to give you a sense, 20 years ago, there were 3,200 companies listed in the UK. Today, half. We have lost 1,600 companies that are no longer in the market. And so it is costing us a lot.
Daniel, I also want to get your take on China. And there's a great chart that, again, this is one of the charts that you look. I don't know whether you look at it weekly or monthly, but certainly it's one of the ones that you highlighted, which is looking at Chinese debt. How does this end? When you see, I mean, this is an exponential,
this is really concerning. I mean, everyone is focused on the positive news that came out yesterday about numbers being slightly better in China. I think it's great, good news, but there are bigger issues affecting China. One is the share of real estate in the Chinese economy, which is 21% of China's GDP. Just to give you a sense, in the US, real estate is only 15% of the GDP, 21%. And we know that the property market is in shambles. And that affects everyone. It affects, any Chinese household. It affects banks. It affects the government. It affects everyone. So this is a very, very strong headwind against the Chinese economy. The second one is the level of debt overall, financial and non-financial debt, which has far outpaced the growth of GDP. And that is really a problem.
But could there be a credit event, a financial crisis because of it, or will it be well managed by the Chinese policymakers?
I don't think it will be a credit event, but I think that the Chinese authorities will have to dig deeper in their pockets if they want to avoid a credit event. I think they are very conservative in their fiscal stimulus package. Yes, it's impressive to talk about hundreds of billions, but given the scale of the issue in China, it requires much more than that. And I think the Chinese government is behind the curve. It's not ahead of the curve here.
Daniel, so I had forgotten that this is the 15th year anniversary of the Lehman Brothers collapse. But one of my favorite authors, John Authors, has a great piece saying, look, happy Lehman Day to all who celebrate. And actually, he argues that the echoes are still with us 15 years later, rippling through Europe and China because of some of the things that happened post-Lehman. Do you see a pre- and post-Lehman world?
Yes, I think the Lehman bankruptcy is like a major event, like the death of John Kennedy. Everyone remembers where they were when it was announced. I remember vividly where I was when the announcement of the bankruptcy happened. Yes, there is clearly a pre and post Lehman world, and I think that, to their credit, I mean, a lot of people criticize central banks. I think central banks have been the saviors of the system in post-2008 and after. And I think one has to credit them for that. And the turning point, as far as the Lehman event is concerned, is to understand that the market itself cannot fix all these issues. You need government and central banks to play a big role.
Daniel, thank you so much. Daniel Pinto there, Stanhope Capital. Now, U.S. auto workers strike at the big three car makers for the first time in history, setting up a showdown over wages and job security. China's economy picks up steam in August after a summer travel boom and more support measures from the central bank. Plus, arms stock higher pre-market, this after soaring in its trading debut after raising $4.9 billion in the year's biggest IPO. Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, ECB Governor Christine Lagarde has raised the European Central Bank's key lending rates by 25 basis points, its 10th consecutive hike. Now, for more on all of this, let's get straight to Bloomberg's Alexander Weber in Frankfurt. Alex, first of all, I know you break news almost every week, so congratulations to you and the Frankfurt team. But were there any signals in Lagarde's speech that the ECB is now done hiking, and how did the markets take it?
Yeah, so the clearest signal may have come in the policy statement already. They introduced a very long and finely nuanced sentence that most took to mean that interest rates have now reached the peak. Lagarde didn't quite want to confirm it in the press conference. She said the Governing Council can confirm that now. But she acknowledged that the focus is going to shift to how long rates will now stay at this restrictive levels, not so much to where they will end up. The market certainly took it to mean that the peak is in. Investors are not pricing any more hikes. Analyst notes, if you read them, nobody expects any more hikes from here on out unless there's a very significant surprise in the coming data in the coming months.
So the ECB has also revised its economic outlook out to 2025. What exactly are the changes?
So the most important change may have been that the near-term outlook for the economy was revised lower. The ECB only expects 0.7% growth this year. Many expect this to be actually too optimistic because the cutoff date was before Eurostat revised down the growth figure for the second quarter. Inflation, on the other hand, was revised up for next year and a bit down for 2025. So the ECB now expects to reach a 2% target in the second quarter of 2025 already. This may have been behind the decision to hike. They didn't want to risk pushing out that date any further. Lagarde said in the press conference that the difficult times are now. They do not expect a recession, but it remains to be seen whether that pans out, and especially how the labor market reacts if growth surprises on the downside in the coming months.
Alex, thanks so much. Alexander Weber there on the very latest from the ECB. Now, for more on the ECB, Europe's economy and markets, we're also joined by Sphia Salim, Bank of America, head of European rates strategy. Sphia, thank you for joining us. Okay, 25 basis point hike, as expected. Were you surprised in Christine Lagarde's language that actually, first, she didn't pre-commit, but she's sticking to the higher for longer?
Yes, and thank you for having me. But certainly, we were expecting the door to rate hikes to be left a little bit more open here, because it is going to be challenging for the ECB to really convince the market that it's not going to cut rates anytime soon. And one way to convince them is to still leave the door open to those additional hikes. So we were a little bit surprised by the fact that it was a little bit more explicit that they were contemplating a pause here, but we would call that a Schrödinger suppose, at this stage, because as we saw, there are already some hawks that are pointing to the fact that a December hike cannot be ruled out.
So, Sphia, how hard is it right now to set monetary policy for Europe? Because I guess even an extra 25 basis points could really unravel the economy.
It is extremely hard, of course. This decision taken yesterday was probably one of the most difficult ones so far in the cycle. And this is the case also for other central banks, which are grappling with inflation being still elevated and first signs of weakness in the data. But what I would say is that at this stage, we are dealing with a central bank that still wants to keep all options open, because if you look at the hard data, it has actually outperformed soft data. So we are seeing signs that actually the economy may be a little bit more resilient than we thought. This is certainly the case in the US, but it could also be the case in Europe.
So how high is the bar actually for raising again, and what does it mean for a lot of the fixed income space in Europe?
The bar is certainly very high. Our baseline is that 4% will be the terminal rate here. And it is true that for fixed income investors, there is this desire to buy duration around the last hike. But we would caution investors of doing that too much in the next few weeks, for sure, because positioning is already long. The end of cycle is a consensus trade, and a small upside surprises in the hard data can certainly still push upward pressure on 10-year yields, in particular in Europe.
Sphia, how early do you think we could see cuts? I mean, is it just wishful thinking from the markets?
Our baseline is still that there will be cutting in the middle of next year because inflation is on a downward path, and we are dealing with a central bank that has already been already in very restrictive territory, so it makes sense that there are cuts happening as inflation converges towards 2%. But at this stage, I think that overall pricing will be quite stable for the very front end of the curve, and it is assessments of the neutral rate and assessments of term premium that can still put pressure on 10-year yields.
So there's a lot going on with euro. How much pressure will euro see from here until the end of the year?
We still see some downward pressure because it's a relative issue, and we have data that actually comes in still stronger than expected in the US. So our FX strategist's call is still that the euro weakens towards 105 by year end.
How much volatility overall? I know you're expecting, I guess, a little bit less volatility in the 2-year rates, but is there a credit event that you worry about in Europe that could really kind of change the game for the ECB?
I mean, there are, of course, a lot of unknowns there, and a shock like the one we have seen in the US can bring forward the pricing of immediate rate cuts. But we don't see anything immediate. What we're watchful for is the tightening of financial conditions that can come from the TLTRO repayments at the end of this year and at the end of March next year.
Sphia, when you look at China, I don't know whether you worry about stagflation in Europe, and really, depending on what happens in China, it could completely unravel and the ECB loses control there.
We are thinking that the market is very much pricing already the weakness in China. When we survey our investors, most of them expect simply some piecemeal measures to be taken there. So there's a lot of pessimism, I would say, that is already embedded on that story.
All right, Sphia, thank you so much for joining us. Sphia Salim there, Bank of America, head of European rates strategy on the ECB, and much more. Now, coming up, sneaker demand spiked following the pandemic. Data suggests the peak has passed. Well, we're joined by Silvio Campara, the chief executive of Golden Goose, the brand behind Taylor Swift's favorite sneakers. This is Bloomberg. The conversations that matter, the insights you need. This is The Pulse. I'm Francine Lacqua here in London. Now, Bloomberg has learned that media mogul Byron Allen has submitted a $10 billion offer to Walt Disney to acquire its ABC TV network and several other stations. Now, for more on this, let's bring in Bloomberg's Alex Webb. Alex, I mean, this is an exciting deal. It's a potential deal. We haven't seen that many deals in this space. Is it because the price is attractive, or it's just the beginning of a consolidation phase to keep costs down?
Yeah, it's this sort of like rejigging of who runs what in media, essentially, because what we've seen with Disney is they have been going into, of course, streaming. There isn't as much growth as there used to be. There's not really much growth at all in linear television, where you're fundamentally dependent on advertising. The thing they've also managed to do at Disney, they, of course, had all these assets they acquired through Fox. A lot of those are the things actually that are feeding Hulu, which is kind of the platform you might think have been taking content from ABC in the past. So it is interesting that Byron Allen is now coming in. It's a $10 billion offer, Bloomberg, or $10 billion offer that Bloomberg is reporting, according to sources. And the fascinating thing here, though, is I think there's wiggle room, right? In this reporting, it says that that's based on the assumption that the properties generate $1.25 billion in EBITDA. If it's higher than that, then the offer goes up. If it's lower than that, the offer goes down. So you sort of wonder how much diligence has been done on this,
right.
But it's, there's a long way to go.
And what's happening at Disney Plus?
Well, ultimately, the subscriber numbers aren't as good as had been expected by the previous CEO, Bob Chapek. That's for a number of reasons. They've increased pricing to offset some of the stagnating growth. It's a sort of chicken and egg thing there slightly. And also in India, where they don't have the cricket rights in the way they had before. And that means that subscribers in India have dropped off quite considerably. The value of subscribers in India isn't actually all that great. Some estimates I've seen suggest they make, 70 cents a month, whereas they make $7.50 in North America. So it's not as appealing from a revenue perspective, but it is from an audience perspective.
Interesting. Thank you so much, Alex Webb, there with the very latest on Disney. Now, I also want to show you what the chip designer ARM is doing. Yesterday it was up 25% after it debuted a pretty big win, actually, for owner SoftBank. Pre-market, it's still gaining in today's trading session, 9% higher. Now, the conversations, of course, that matter coming up. We bring you a conversation with the chief executive of Golden Goose for London Fashion Week. This is Bloomberg. The conversations that matter, the insights you need. This is The Pulse, and I'm Francine Lacqua here in London. Welcome back. So sneaker demand, or trainers, because I'm going to get in trouble with my British colleagues. Trainer demand has spiked following the pandemic, but data actually suggests that the peak has passed some time ago. Now, Golden Goose is a favorite brand of celebrities like Taylor Swift and Selena Gomez. It's aiming to appeal to the environmentally conscious Gen Z by offering in-store cobblers, for example, to repair their $500 shoes. Now, despite inflation squeezing European consumers, Golden Goose reported 25% growth in the first 6 months of the year. And joining us now is Silvio Campara, Chief Executive of Golden Goose. Silvio, thank you so much for joining us. I mean, you have a pretty extraordinary stories because, when you started out, a lot of people would say, well, how many pairs of trainers or sneakers do people want? And you've managed to put yourself in price point, but really at the top end of desirability. Can you grow from here?
Seems that, in the last 23 years, we have been growing, okay? So it looks like, there's still space, not just for sneakers, but for the way we approach sneakers, So we are coming from the 90s, 80s, 70s, where sneakers, it was mostly about performances, so to jump more, to running faster. And then I would say that Golden Goose probably has been one of the pioneering in shifting everything from performance to emotions, sentiments. So now sneakers are not anymore just an object, but it's memories that you can collect along the years.
But so this is through experiences. But again, what makes people buy a $500 sneaker? I think is probably the question for investors.
Uniqueness of the items, because there's a specific strategy behind. Because it's easy to get bored about a sneaker because usually you don't pay that much attention because it was more functional. While Golden Goose has been the first to have a completely unique approach in changing the merchandise strategy by giving to the audience and the lovers a different specific offer depending by region, by channels, by city.
Right.
And this is making the people excited and having always the feeling of collecting the items. And for sure, we never do replenishment, which is quite unique. So every single piece you buy is one. And one last thing, we are the only brand on earth that do sneakers handmade.
Silvio, so first of all, is there a price sensitivity? Or actually, do you feel like you can actually increase and that's not a problem, which means that you have very healthy margins and that will continue to be the case?
No, I think sneakers are not bags, so there's no space to increase that much the prices. So of course there's a bit of inflation inside, but there's not that much space. I think it's very important, it's part of the marketing and the sustainability, the real sustainability, that to me is first of all the relationship between you and your people.
So you were telling me, I think you sell 2 million, right, sneakers a year. That's pretty incredible.
Units,
so
yes.
is this U.S. mainly, or is it really across the globe?
It's almost 45% of our business, and I would say all over the world. We are more than 92 countries all over the world.
And so are there regions where actually demand can increase more significantly than it is now?
Yes, and I mean, it's not me that can say that. I mean, it's the fact, If you look at sneakers, it's not just a category. It seems to be the gate for all new luxury consumers. And so what is really brilliant and amazing and can give the real answer to your question is the age of our consumers. Because, bags is mostly on millennials and X generations, while sneakers can really open to you the wide and huge basin of Z generation. So actually giving you the longevity of the business rather than just the verticality of the business.
Okay, so you're selling to a younger population.
Yeah, not only, but
which is brilliant because this is maybe what some of the other legacy brands want. How do you sell more to them? Is it different categories or just by doing the same?
Organic, because the new generations are now into status, they are into relations, human relations. And seems that our execution, is really into that, and seems they are happy and they are repeating and repeating and repeating and promoting and promoting. So word of mouth is really important.
There's a trend towards quiet luxury, and I know there's been Netflix shows because of Succession and things like that. Is that the space where you see yourself? Are you quiet luxury or are you not so quiet luxury?
No, I'm not surprised about that. Yeah, I think, I think we are the result of the reality outside there. So there's very little strategy in Golden Goose, and there's really a lot of organicity, in what we are doing. Yeah.
So talk to me a little bit about your plan. I mean, would you IPO? Birkenstock did a very, very healthy IPO. Is it something that you would consider?
First of all, congrats to Birkenstock. And in my case, my job is really to give multiple options, to our shareholders, and that's my job, to really make that. So if eventually in the future there's going to be that option, why not?
What are market conditions looking at? I mean, do you test market conditions to make a decision on a possible IPO?
No, the most important for me is to have really a strong narrative and to make sure that we have a strong vision in order really to make the brand and all our people, be the strongest and the most excited possible.
So talk to me a little bit about the clothes. So this is what, 10% of your revenue?
Yeah.
Is it a tougher market because of rivals or certainly many other designers out there, or is it supply chain issues, or are you just happy with having it as a 10%
Yeah,
revenue?
I mean, our business is sneakers, so our priority is to make sure to be strong in there, ready to wear is part of the narrative, but it's not our priority.
So you're here for London Fashion Week.
Yeah.
Has London changed?
We always love London. We think London is unique in terms of energy, in terms of communities, and I think there's still a lot that we can grab from London and from his incredible ability to rechange, itself. So,
I mean, you also have this interesting collaboration with cobblers that come in certain of your stores.
Yeah.
Is there anything else in the pipeline? I don't know whether it's, is that the model that you just want to offer, whether it's an experience or even some collaboration maybe that's
Yeah, it's not one of the experiences. Our experience is very clear. We want people to be part of the process. We want people to be part of the change. So same as, with the co-creation, we help people to unleash their creativity. With the repairing, we help them to be part of this, making the world a better place. So there's no sustainability without having the people engage with you. So this, if you ask me what is our mission now, is we did an amazing job in these first 3 cities, so now we need to bring this to the world.
How many pairs of sneakers do you have? Of
Me,
golden,
myself?
You, yourself?
Honestly, more than 3,000, yeah.
Wow. Okay, that deserves a whole show in itself. Silvio, thank you so much for coming on. Silvio Campara there, the Chief Executive of Golden Goose. Now, let's also get to some of today's other top stories. BP looking both internally and externally for a new Chief Executive Officer to replace Bernard Looney, who left his post abruptly after failing to fully disclose relationships with colleagues. Now, the chairman, Helge Lund, told staff in a CEO search process has started. Looney's sudden departure after less than 4 years in the job means there was no succession plan in place. Now, the U.S. president's son, Hunter Biden, has been indicted on federal charges of lying about his drug use when he bought a gun 5 years ago. It follows the collapse of a deal under which Hunter Biden would plead guilty to misdemeanor tax crimes and to acknowledge a firearms violation without a conviction. Now, the indictment actually means that he could go on trial during next year's election. The president's son has said that he was in the grip of a long-standing struggle with substance abuse. And the state of Georgia's plan to keep Donald Trump and 18 other defendants in a mega trial over the 2020 election has actually fallen apart. Now, a judge split the prosecution in 2 and said further divisions may be necessary, leaving the date of the former president's trial up in the air for now. Britain, France, and Germany reported to have announced they will keep their sanctions on Iran related to its atomic program. The measures were set to expire in October under a timetable in the now defunct nuclear deal between Tehran and world powers. Now, the European allies say the move is due to Iran's severe non-compliance with the accord. Now, coming up today, the EU Economics and Financial Affairs Ministerial meeting is taking place in Spain, so don't miss our exclusive interview with the Spanish Economy Minister, Nadia Calvino, on the Surveillance Early Edition, and that's at 10:30 a.m. London time. Also, later today, our conversation with the French Finance Minister, Bruno Le Maire, that Bloomberg exclusive just after 3 p.m. London time. Now, the other thing, of course, we keep on watching is what's going on with ARM. This is the biggest IPO of the year. ARM pre-trading actually getting some 9% yesterday. After it listed, it had a pretty big boost already. So there's a lot of questions about whether they still decided to go in the U.S. instead of Europe, what that means for everything else, of course, for other companies that want to list here. Now, ARM's highly anticipated trading debut really has caught the attention of retail traders. For example, if you look at the chip designer, it garnered the most buy orders on Fidelity's trading platform with an upward of 20,000 purchase orders. Up next, Bloomberg Surveillance Early Edition. This is Bloomberg.